Good morning.
Good morning.
And
Good morning, sir.
Morning, sir.
Good morning, sir.
so we can wait few minutes for others to join. Meantime, if you have any questions, please go ahead.
Right, page number 37.
Page number 37 of
Foreign exchange 2.
Foreign Exchange 2.
In that we did that trading effects question in the point of view of a market maker. Shall we do a question on the view of market taker as well, buy sell and sell buy?
So sorry, I didn't get that.
Last week we did a question on related to page number 37 question. In that we did only market maker point of view, this buy sell and sell buy. Shall we do a
Yes.
question on market taker point of view as well?
What's the difference between market taker and market maker? Whenever market maker does a buy sell, market maker does a buy sell transaction, market taker is doing a sell buy transaction. The figures and everything would be the same because there can't be two different figures. No? You do the trade at the same rate, but two parties are participating in different on opposite side of the transaction. One is buying, other one is selling. So the first leg, in a buy sell transaction, first party buys, second party sells, and in the second leg, first party sells while the second party is buying. The reverse. Oh, same thing, same numbers, same figures. Only thing is one is buying, other one is selling. That's the difference. I'm not sure what do you expect from that.
Nothing, sir. Just a doubt only. So same method, no?
Yes, same method, but only thing is you have to pick what is the correct side as a market maker or a market, whether you are a market maker or a market taker. If you want to do a buy sell, what is the applicable points? Say in this example, market maker quote this 248, 255. And it says taker decide deal at 255. What does it mean? What is the transaction that market taker enters into? In on sub points, market taker agrees to do the trade on the offer side. What does it mean? In the far leg, market taker will buy. That's why he prefers to go on the offer side. Offer side always market taker is buying. So the market taker is buying. But in this case, on the far leg. On the near leg, then market taker is doing the opposite of that. That means sell. So from market taker's point of view, it's a sell buy transaction. Then market maker's point of view, it's a buy sell transaction. Is it clear?
Okay, sir.
Anything else? So if you don't have any questions, we'll start the session. But before I start, I'll summarize what we discussed last week. I hope you can see the full board. Somewhere.
Yes, sir.
Yes.
Yes, sir.
Yes. Fine. So we start. Last week we discussed effects, forwards, and swaps. FX forwards and swaps. What's the FX forward transaction? What's the FX forward transaction? It's an FX transaction with a settlement date beyond spot date. This is trade date. This is spot date. That means 2 business days in between trade date and the spot date, 2 business days. So wherever the settlement date somewhere here, after the spot date, we call it as a FX forward. And it's FX forward outright because you just buy or sell only one thing. Is it clear? What's FX forward transaction? That's a foreign exchange buy or sell agreement, but with the value date falls beyond or after the spot date. That's the meaning of spot. What's the FX swap? What's an FX swap transaction? It is a simultaneous buy and sell, but on 2 different value dates. You enter into agreement to buy or sell on a one particular value date and to do the reverse of it or the opposite of that on another value date. So in this there are two value dates. There are two value dates. This is trade date, value date 1, value date 2. Value date means, or you can say settlement date. Remember that value date or the settlement date are the same. This is we call near leg, and the second one we call far leg. If we agree to buy here, buy the base currency on this date, what do you do? On the far leg, you sell it. So then it's a buy-sell transaction. But if you agree to sell here on the first value date, then the second value date you buy this car. Then it becomes a sell buy. Then we call it a sell buy transaction. It's a buy sell swap or a sell buy. So what does it mean? From a single or from a particular party's angle, in the near leg, that party buys foreign currency or generally base currency, and in the far leg, that party sells base currency. In a sell buy transaction, one party is selling base currency in the near leg and buying that same base currency in the far leg. That's a swap. Whatever you do here on the near leg, you reverse it in the far leg. Most of the time, the value date 1 is spot date. Then value date 2 is a forward date. But there can be instances where both value dates are forward settlement dates. That means even the value date 1 falls after spot date, then the far leg value date falls even after that. That's the basic. So then we move into how to calculate FX forward rate. How do you calculate the FX forward rate? It's the equation. This is the ratio between future value of two currency amounts. You may remember that's the definition. Based on that, we derive the equation spot into 1 plus interest rate on the counter currency into number of days divided by day count. Everything divided by 1 plus interest rate of the base currency into number of days of that particular forward transaction divided by the day count. What does it mean by the day count? Number of days per year. What is the day count basis? That's day count basis. That's the equation. Then we discuss something called forward points. How do we calculate forward points? How do we calculate forward points?
Forward rate minus spot rate.
Forward rate minus spot rate. But generally, When you do this, it will come as a decimal figure. But generally, forward points are expressed in terms of pips or the points. How do you convert that? How do you convert forward points? Sorry, whatever the decimal figure into pips or points?
Multiply by 10,000 or 100.
Is it multiply or divide? You want to when you want to convert the decimal figure into pips, you multiply it by 10,000 or 100. Correct. When do you multiply it by 10,000? When do you multiply it by 100?
When there are 4 decimals, you will multiply by 1,000.
Yes, in the exchange rate is expressed up to 4 decimal places. Then you use 10,000. For the currency pairs, there's only 2 decimal places. We use 100. Then we discuss when the spot rate is given. What is given? Forward points are given. Spot and the forward points both are given with bid and ask. Then how do you calculate the forward rate? For example, this is spot forward points, say 1 month. What is the forward rate? How do you calculate it? How do we calculate this forward rate? How do we calculate forward rate in this instance?
Forward points are divided by 10,000
Forward
and
point,
add it for the buy and sell.
buy and sell. But remember, we have to check these 2 figures properly. If the
premium,
bid is lower than the offer side, then it's in the proper order. That means you add swap points to the spot rate as it is, bid to bid, offer to offer. Before you add, you have to convert these pips into decimal place. So therefore, you divide it by 10,000 because in this instance, you can see the exchange rate spot rate is quoted for 4 decimal places. So therefore, it would be 1.3219 plus 35 and 1.3222 plus 38 points. $1.3260 is the offer. $1.3254 is the bid. again you can cross check whether bid is lower than the offer. In this case, bid is 54, offer is 60. So this is 1 month forward trade given this information. But what do you do if instead of 35, 38, it was like 38, 35? Then what do you do?
You have to subtract.
You have to subtract or deduct stop point from the spot rate. What does it mean by this 38, 35? Stop points are negative. That means the difference between forward rate and spot rate is negative. In this instance, we subtract 38, 35. What are the answers? Still you can see bid is lower than the offer. Is it clear? Then we discuss about in this
Sir.
example. Yes.
So I have a question that bid and operator say always the bid is low and offer is higher. So always the case.
That's always the case, and except for these forward points. Forward points, bid may be higher than the offer if there's no sign. But what this implies is that these are negative points with the sign. When you write it as 38 minus 38 and minus 35, still you can see this is lower than the offer. Bid is lower than the offer. But when you see here, you see it other way around. Without the sign, you see bid is higher than the offer. That implies the stop points are negative.
So if that the difference between the 38 and 35 is that means very high, that it then offer can be that other way around, no?
No,
It's never happened.
you make it 38, 35 instead 18, 65. Sorry. Yeah, 18. If it is 1865, then again this implies that points are positive. Still, you will get a lower bid and higher offer. If you make it other way around, 68.15, then the points are negative. Still, it will reflect. It will give you lower bid and higher spot.
Okay, sir, thank you.
Anything else? Now tell me, when do you get positive points And when do you get negative points? What's the reason? For some currency pairs, you will get positive points. For some currency pairs, you will get negative points. What's the reason?
Positive we get when the forward rate is higher than the spot rate.
Yes, but I am asking, what's the reason?
The difference between the interest rate.
Yes, that depends on the relationship between these two interest rates. So, what should be the relationship to you to get a positive point?
RC higher than the RB.
Yes. When the counter currency interest rate is greater than the base currency interest rate, then we'll get positive points. Then we'll say base currency is at a premium. We get negative points when RC is less than RB. That means interest rate of the counter currency is less than the interest rate of the base currency. Then this instance, base currency is at a discount. So this is about forward transactions. When it comes to swap transactions, generally we use the mid rate as the reference to the spot. What does it mean? In my previous example is correct. These are the two rates, 19 and 22. What is the mid rate? What is the middle? Three, two. So we use this rate as the spot reference rate instead of using a bid and offer for the spot. But stock points still we use bid and offer. Then we add that bid rate to the middle rate to get the bid of the par leg. If you want to get the offer of the par leg, we add that points to the mid rate. All these things we discussed last week. Not only that, we discuss an equation how to calculate FX or forward points straight away. What is the equation for that?
Sir, I have a question.
Yes,
Why, for socks, why do we take mid rate, sir?
mid rate.
Yeah.
Yes, because when you trade a swap, what matters is the interest rates. Because you buy and sell the same base currency on both legs, the difference comes in the interest rates. So trader worry about only the interest rate. What is the interest rate charge on you, or what is the interest rate that you receive? So therefore, you don't worry about the spot rate. That's the base.
Okay.
That's why we don't worry about the spot rate, because whatever the base currency amount you receive, you have to pay the same base currency amount. Then whatever the spot rate you use to convert that base currency amount to counter currency amount, you pay or receive that interest on that amount at the end of the period, or that means at the end of the second leg on the value date. What matters is what is the interest rate, not the principal amount. That's why. Okay, what's the equation for the forward points? We can calculate forward points straight away. That is same thing, 1 plus RC number of days divided by the basis divided by 1 plus RB space divided by basis. Basically, this is the equation for the forward trades. Forward points are forward trade minus spot. This time, this part is the forward trade minus S. So this is the equation that we use direct to calculate forward points directly. Now the thing is, again, we discussed even the interest rates are quoted in the market as bid and offer interest rate. Then what are the interest rates? Whether you use bid rate or whether you use offer rate to calculate the forward points matters. Based on that only you get a bid point or offer point. If you use the same rate, you would get only 1 point. You don't get 2 soft points. To get 2 soft points, you have to use different bid interest rates and offer on interest rates in these places. We discuss that as well. Then I explain say soft points are, as I mentioned earlier, 35, 38. These are the soft points quoted. Market taker. Trade at 35. this is the quote. 35, 38 forward points are quoted in the market. Market take a trade at 35. What does it mean? What is the transaction entered into by the market take? Okay, to make it easy, we will say this is based on Euro USD. The currency pair is Euro USD. 1 month forward points are 35, 38. What is the trade that the market trader enters into?
Buy sell USD.
Sorry,
Buy sell USD.
buy, sell USD.
Yeah.
So what does it mean?
Sell by euro, right?
Buy, sell USD. That means near leg buy USD, far leg sell USD. This is the first answer. Any other answers?
Buy sell G euro.
Buy, sell euro. That means buy euro in the near leg and sell euro in the far leg. Anything else? Is there anyone who's telling it's a sell by dollar or sell by euro? Okay, what's the correct? If you don't have any other answers, okay, we have only two options. Which one is correct?
Second one.
Second one. Why?
Because market take a always buy for a lower price and sell for a higher price.
Mhm. So you trade this 35. Is it the low price or the high price?
Low price.
This is low price. Okay. At low price, what do you do?
Buy.
As a market taker,
Sell.
you sell. Then the question is when? Near leg or the far leg? You sell here or you sell here?
Near leg sell.
Near leg sell.
But this is forward points, right? So is it on the far leg?
Yes. This is forward. Remember. This is forward. So you add these forward points to the spot trade, then you derive the forward trade. So you agree on the forward trade, not the spot trade. So therefore, this trade is applicable for the far leg, not for the near leg. So therefore, you sell this in the far leg, not in the near. So you sell in the far leg. What do you sell? That's the other question.
Base currency.
You sell base currency. What's the base currency in this pair?
It's euro, sir.
Euro.
So then the answer is this one. Buy sell euro. Is it clear? So remember, in a soft transaction, you
Excuse me,
agree.
sir.
Yes.
Sir, the 35 is from the market taker point of view. It's going to be buy, no?
That's the basic. What do you do at the as a market taker? What do you do at bid and at offer?
See, we are going to buy at 35
As a market taker,
on the forward rate.
Forget about whether it's a forward or a spot at the bid. What you can do as a market taker,
Right, should be
irrespective
sell,
of it,
sir.
huh? Irrespective
Yeah,
of whether you are whether it's a forward transaction or a spot transaction, whatever. What do you do as a market taker at the bid price? You can
sell.
You
Yeah,
can't
sure.
buy.
Yeah. Yeah. Thanks.
Anything else? Okay. Now, whether you receive this or pay this,
So we receive.
as a market taker, when you trade on the low price on the on a soft transaction, market taker receives this stock price. What does it mean by receive? Say you, this was a buy sell transaction, buy sell euro transaction. Assume spot is, can't remember what was the rate. 3219 20 whatever. Assume this is the spot rate. In this instance, you don't want these two as it is a swap. We assume it as 1.3120. This is the reference spot rate. These are the forward points. You agree to trade at 35. However, what is the forward rate? $1.3155 and 1.3158. Correct? These are the forward rates, bid and offer. You agree to do a buy sell. That means you buy euro in the near leg and sell it in the far leg. Assume the amount is euro 1 million. Near leg. How many dollars you pay? To buy euro 1 million, you pay how many dollars?
$1,312,000.
You need 1 million and 312,000. How do you get it? Spot rate multiplied by 1 million. This is the amount that you pay to buy dollars. Then in the far leg, you sell euro. Then you receive dollars. Here you buy euro 1 million, and here you sell euro 1 million. The quantity is same in the base currency. The difference comes in the dollar amount. What is the amount that you receive in dollars? What's the applicable forward rate? You traded on 35. That means at the bid. So applicable rate is the bid rate 1.3155. What's the dollar amount then? 1,315,500 dollars. What's the difference? $3,500. It's a plus for you. You paid only 312,000. You receive 315,500. 3,500 difference is there, and it's a positive. Clear? So you receive it. That's why we say you receive this 35 tips. Clear? Any question?
Excuse me, can
Yes.
you explain this example again?
Which part?
This far leg part?
Far leg part. Okay.
Yes.
What do you do in the far leg?
Far leg, you receive USD
Why do we receive USD?
because we sell euro.
What's the applicable rate? You sell euro 1 million. What's the applicable rate?
For 1.3155.
1.3155. Why? Why this becomes applicable rate, not this one? The reason you agree on 35. 35 is in the bid side of forward points. That means you agree to sell in the future. So then you sell at the bid rate. Even here, then the applicable rate is bid rate. Okay, 1.3155 is the applicable rate. Then when you sell euro 1 million at this rate, what is the amount of dollars that you receive? You sell euro 1 million at 1.3155. What is the amount of dollars that you receive? You sell euro 1 million. The rate is 1.3155. What is the amount of dollars that you are going to receive? How do you calculate that?
Is it multiplied by 1 million rate?
1 million into this rate.
Rate.
Because what does it mean? 1.3155 means 1 euro equals 1.3155 dollars. Then 1 million euros equal to 1.3155 into 1 million. So you will get this amount. Correct?
Yes, sir. Got it.
Then the amount that you receive is higher than the amount that you paid. So that means you gain. You make a profit or you receive something. So basically what you receive 35 points on 1 million. That is in dollar terms 3,500. So the basic rule is, as a market taker, if you trade on the lower price, you will receive it in an effects of, as a market taker. If you trade the lower price, you will receive it. If you trade the higher price, you will pay it. Clear? Is it okay now?
Okay, sir. Thank you.
Others? Is there any question? If you agree to trade at 38, then what do you do? as a market taker, you agreed to trade at 38. What do you do?
Sell by
Sell by what?
Sell by euro. Right?
euro.
Sell by. You enter into a sell by euro. You sell euro near leg. You buy euro par. So then near leg. What is the dollar amount that you receive? It is still the applicable exchange rate is 3120. So 1 million and 312. In the far leg, you buy euro, so you have to pay. What's the amount that you pay? What's the applicable rate? What's the applicable rate?
1.3158.
1.3158. Then the amount that you pay is 1,315,800. What's the difference? It is negative 3,800. What you pay is more than what you receive. So it's a negative flow. You make a loss or you make the payment. That's why we say whenever you trade as a market trader at the high price, you pay the price or you pay this soft price. Clear? Is there any question?
So this is the same story when the currency appreciates or depreciates, right?
What do you mean?
So if the counter currency like appreciates and even depreciates, you end up paying at low price and paying at high price and receiving at low price.
Yes. So at the beginning, I mentioned forward trade is not a forecast for the spot trade. That's one. And whatever the market price prevail at the time you settle the transaction, it doesn't matter.
Since this is pre-agreed.
Yes, the price is pre-agreed. You trade it or you settle the transaction at the agreed price.
Okay. Okay. Thanks.
Clear?
Yes, sir.
Okay. Anything else?
Sir,
Yes.
that euro trading at premium means that is the expectation that euro will go up in the future. Is that the case? From that rate indicator?
Were you listening to me? Just now uh,
Yeah,
I explained.
I'm asking about that points, lesser amount and higher amount.
Sorry?
That's point. I'm asking about the points that says that as 35, 38 now.
Yes.
That's positive. So that indicates that euro will, expectation is that euro will go up, euro appreciate.
Oh, that's what I told you just now. Forward trade, it doesn't give any indication of whether the currency is going to appreciate or depreciate. It's not a forecast about the future exchange rate. It's basically reflect the difference between uh, two interest rates prevail at the time that you entered into the transaction. Even it does not reflect any interest rate movements in the future. It reflects only the interest rate differences as at now when you entered into the transaction. No forecast.
So we cannot take any indication from that rate. No?
No. If you go and check in the history for different currencies, what were the forward points and say 3 months forward points or 6 month forward points, and what has happened to those currencies, especially check like exchange rates in dollar yen, not even that, dollar euro, dollar sterling. So if this is the case, it should be one way, but it's not the case. Currencies appreciate, depreciate. It's volatile.
Okay.
If you can use this as a forecast, everybody will buy when the points are positive and the the currency is going to depreciate in the counter currency is going to depreciate in the future. So everybody will buy the base currency. Then it will be one-way market. Won't happen.
So this is a market maker's perception of what is it going to be, or is it like
Nothing, as I mentioned. The market maker's perception can be incorporated into the spot trade. When they quote, can you remember we discussed about how to trade in the trending market? If you think exchange rate is going to go up, you quote as a market maker, you quote a slightly higher bid than the others.
yeah.
Then the market rate will start to go up because others will do the same thing if
Really, yeah.
they think that way. But if you think exchange rate is going to go down, what do? You quote lower prices than the market. Then the exchange rate goes down with that. But when you quote forward points, forward prices, no, that only you may incorporate some view on your interest rates into the interest rates. Then you make that price. But if it is far away from the market, off market, then nobody will trade with.
Okay, that makes sense. Yeah.
Is it clear now?
Yes, sir. Yes.
Okay. But you can use this FX forward outright transaction to speculate. Say, for example, in this euro-dollar exchange rate, I got it like 311 3122. This is the current market price. If you think euro appreciate, what you would like to do? If you think euro will appreciate in the future, what would be your action?
Buy some euros.
Buy euro. So what you can do, you buy euro for, and say you assume that euro appreciate in 1 month time. You buy euro spot and keep it for a 1 month period. After 1 month, euro dollar exchange rate, it may be 1.31, 50, 53, something like that. That means euro has appreciated 3119, 22, 3115, 53. So it has appreciated, or it can be something like this. In the first scenario, you will make a profit because the exchange rate has gone up. You can sell the euro that you bought one month earlier. You can sell it at a higher rate. But in this case, you can sell it at a lower rate, then you will incur a loss. That is speculation. Whether you make a profit or loss depends on whether your VV is realized or not. Clear?
Okay.
Okay. This is the spot transaction. But how can you use a forward transaction to do that? So in this instance, what do? You buy euro and keep it for 1 month. So you give some dollars, take some euros and keep it. That means you give up dollars, you take euros and you can invest that euro for a 1 month period and earn some interest. So you earn interest on euro, you give up interest on dollars. What we do in a forward transaction. Instead of doing a spot transaction, you can buy euro 1 month forward. You can buy euro 1 month forward. So then the applicable rate would be 1.3135 or something like that. Based on the forward points. This would be the applicable forward rate. After 1 month, you pay some amount of dollars and buy euro, whatever you want at this rate. The amount you agree at the time you enter into the transaction. But still you have to honor this transaction. After 1 month, assume again 3155.58 or 3105.08. After 1 month, again, the outcome would be one of these. Either euro has appreciated or euro has depreciated. Whatever the amount that you amount of euro that you buy on the forward contract, you can sell it at the spot price prevail at that time. If the market rate is higher than this rate, you make a profit. If the market rate is lower than that rate, you make a loss. That's how you use FX forward transactions to speculate. Only thing is, in this, you don't need any dollars at the time you enter into this transaction. You need dollars only after 1 month. But if you do this trade as explained earlier on the spot basis, you need dollars today to buy euro, and you have to keep that euro for a 1 month period. The same thing, you do it here, like you borrow euro and you borrow dollars and lend euro, it will be reflected in the forward price. Same thing. That's how you use to speculate or to get the advantage of your market, how to speculate. Either you can use a spot transaction or a forward transaction.
Excuse me, sir. Sir. Excuse
Yes.
me. These gain and losses are opportunity costs, no? Not the accounting profits and losses.
Oh, these are okay. This would become 3155.58. Basically, you have to sell euro in the market only at 3155. It's accounting profit or loss. You bought at 3135, you sold at 3155. Then it's a accounting profit. Everything. Why don't you account anything?
Okay.
Whether it's a realized or unrealized, that depends. To honor this forward transaction, then you pay 1.3135 to buy 1 euro, but the market price is this. But still you hold on to your euros, then it would become unrealized profit. Your profit may change with the fluctuations of the exchange rate hereafter. But the moment you buy this euro on the forward date, if you can sell it at this rate, you will realize the profit. At the time of after 1 month period, you have this profit in your books, whether it's realized or not. That's the only problem. Everything will be accounted. Anything else? Let's move into how to trade foreign exchange. swaps. So slide number 44 on the handout. As a market maker, when you trade FX swaps, how do you make profit or loss, and how do you calculate it? So two examples are given here. On the difference is to calculate a profit or loss, we have to think about two transactions, two opposite transactions. In the first example, we assume the same spot price is applicable for both transactions. In the second one, we assume two different spot prices are applicable for the two different two transactions. So the example here, there's a bank called ABC Bank. It's the market maker. That market maker enters into two trades in euro dollar. The first one is 3-month buy sell swap with a bank called Big Bank for euro 10 million. So what is the agreement? The ABC Bank enters into a swap transaction on euro 10 million with a bank called Big Bank for a 3-month swap to buy sell. Near leg bank ABC buy euro and far leg ABC Bank sells euro. Meantime, ABC Bank enters into another transaction for the same period, 3 months, with a bank called Zero Bank for the same euro amount, but on the opposite side of the previous trade. Previous trade was a buy-sell transaction with Big Bank. Now with the Zero Bank, the transaction is a sell-buy. So the cash flows will be set off in both legs. Assume the spot rate is 1.3792 and the swap points are 3.6 and 2.5. So is it clear, the given information? And what do you derive by looking at these points? Whenever you see these points,
They're negative, right?
you should realize that they are negative. Yes. Okay. Then how to calculate the profit? Before we calculate the profit, we'll have to understand what are the two trades that the ABC Bank has entered into and at what are the applicable trades. Okay, what is the applicable rate for the ABC Bank in the first transaction, 3-month buy sell swap? What is the forward rate applicable for the ABC Bank? Whether ABC Bank trades at 3.6 or 2.5 in the first transaction.
$2.5.
2.5. Why? In the far leg, ABC Bank sells. ABC Bank is the market maker. Market maker sells at the offer. So the applicable rate is 2.5. Then you can calculate. But remember, it's a negative point, then you can calculate what would be the forward rate. Then obviously for the second transaction, the applicable rate would be 3.6 because it's the opposite of the first transaction. Instead of a buy sell, you do a sell buy. Forward leg, ABC Bank, market maker is going to buy. Market maker buys at the bid price. So the applicable points are 3.6. So we'll put all these things into a table or a spreadsheet and see what is the result. So you can do it in an Excel. The customer name, who are the customers of ABC Bank, Big Bank and Zero Bank. Trade amount euro 1 million. There's no difference. So as I mentioned earlier, for the first transaction, the applicable swap points are minus 2.5. For the second transaction, applicable swap points are minus 3.6. Then the spot rate is given 1.3792, and we assume for both trades the same spot rate is applicable. So the spot anchor, that means what is the spot rate applicable, is the same 1.3792. Then what's the applicable forward rate? How do you calculate this? How do you get this? The spot rate 1.3792 minus 0.00025. Then you should get 1.3789. Since this is a negative point, forward rate should be lower than the spot rate. Then how do you calculate the euro cash flows? That's the amount that you are going to buy in the spot. So here we refer to the spot cash flows. Even though the forward rate is calculated here, cash flows are for the spot. You buy euro 10 million, so therefore the cash flow is positive. What is the dollar cash flow? What is the amount of dollars that you are going to pay? Since you are paying, it's a negative cash flow. How do you get this? This spot rate into 1 million. Sorry, 10 million. You get 13,792,000. The same for the second transaction, but the cash flows are in the opposite direction. In the second transaction with the Zero Bank, near leg you sell euro, you means the ABC Bank sells euro and buys dollars. So same spot rate is applicable for the same euro amount, so you should get same dollar amount. On the net basis, it should be 0. Then on the spot date, you buy euro 10 million, pay $13,792 from Big Bank. Same time on the spot date, on the same spot date, you sell that euro 10 million to Zero Bank and receive the same dollar amount. So on the spot date, cash flows are 0. No gain, no loss. But what are the cash flows in the far leg, forward leg? So with the Big Bank, it's a buy sell transaction. You bought euro on the spot date, then you sell euro on the forward date. So therefore, there's a negative 10 million cash flow here, and the equivalent dollar amount is calculated based on the applicable forward rate 1.37895. So therefore, when you sell $10 million to big bank on the forward date, you receive, or the ABC bank receives, 13,789,500. You settle the transaction with the zero bank as well, in which you agreed to buy euro 10 million on the forward value date. So you receive 10 million euros while paying 13,788,400. How do you derive this figure? This is 1.37884 into 10 million. So the difference is what the dollar amount that you receive and the dollar amount you paid. There's a difference of $1,100. So that's the profit. Is it clear how to calculate this profit or loss? Only thing you have to decide is what is the applicable forward price. Then you can enter some cash equations here. All this will be automatically calculated in an Excel sheet. You can do it in a spreadsheet. Any question? Any questions? If you don't have any questions, we can go to the next one. In this, as I mentioned earlier, we assume two trades are taken place at two different spot prices. The information is given here. For the first trade, again it's a buy sell swap, 3-month buy sell swap for euro 10 million. The spot is 3792. Forward points are minus 2.5. The second transaction, the sell buy transaction, is at spot 3791 instead of 3792. The spot rate is 3791, but still the forward points are minus 3.6. We can do the same calculation and see what is the result. So trade amount euro 10 million in both. Then the swap points are minus 2.5 and minus 3.6. Spot anchor, now spot rates, we have two different spot rate, 1.3792 and 1.3791. Forward prices, again make the adjustment to this spot rate based on the swap points. 1.3792 minus 0.00025. Then you get this. Here 1.3791 minus 0.00036. Then you get this forward price. Cash flows. What is the euro cash flow? This is a buy sell transaction, the first one. ABC Bank receives $10 million, 10 million euros while paying $13,792. In the second transaction on the spot date, ABC Bank sells euro 10 million while receiving only $13,791. So on the spot date, there's a short of $1,000. You need to fund this because to buy you have to pay 13,792,000, whereas you receive only 13,791,000. So there's a shortage of $1,000. Need to finance this position for a 3-month period because these two transactions are for 3-month period. Then after 3 months, on the maturity date of the transactions, in the first transaction, ABC Bank sells euro. So therefore the euro cash flow is negative, but with the zero bank, it's a positive cash flow because ABC Bank buy back euro 10 million. Then the dollar cash flows can be calculated based on the forward rates calculated here. So accordingly, from the when you sell or when ABC Bank sells 10 million euros, the bank receives $13,789,500. On the second transaction with zero bank, ABC Bank buys euros from zero bank, paying $13,787,400. Again, you net it. Euro cash flows will be cancelled out. The net amount is zero, but there will be a difference in dollar amounts, which is positive in this example. So you get 2,100 gain. But remember, you had a loss of 1,000 on the spot date. So ignoring the time value of this $1,000, you can say net profit is 1,100. On the forward date, you earn 2,100. Spot date, you lose $1,000. So the net net is 1,100, but in reality, it would be slightly less than that once you consider the funding cost of this 1,000 rupees. So that's how you trade FX swaps and calculate profit or loss. Any question? If you don't have any questions, we'll move forward and try to finish it. We have only two more slides. So again, remember FX swap transaction, FX swaps, they do not create an FX exposure. You don't get any exposure. In both these examples, you saw euro amounts zero. Once you enter into these two transactions, euro amount is zero here. So no exposure that you carry. Even in this example, no euro exposure that you carry. You had $1,000 that you have to fund. So therefore, you cannot make profit from exchange rate movements. You cannot make a profit or a loss from exchange rate volatility, but you can make a profit from in the volatility of swap price. If you trade FX swaps, your source of income is volatility in the swap points. From where we get the volatility in the swap points, that is through the volatility or the changes in the interest rates of these two currencies. So when you trade FX swaps, the underlying variable is, or variables are, two interest rates. Whenever the interest rate changes, swap point changes, that will give you profit or loss. So in summary, FX swaps does not create any FX exposure. So therefore you cannot make a profit from exchange rate volatility using FX swaps, or you cannot use FX swaps to hedge your FX exposure. You cannot hedge FX exposure. But only thing is you can use to cover mismatch of cash flows. You can use FX swaps to cover mismatch of cash flows, timing of cash flows. Say you have a euro payment today and a euro inflow in 1 month time. So what you can do, instead of buying euro today and make the payment, and whenever you receive your euro inflow, sell it and get other currency. Instead of doing that, two different transactions, you can enter into a swap transaction to do a buy and sell. Then you use your future forward or the future euro inflow to make the payment today. So, therefore, it can, or FX swaps can be used to cover mismatch of FX cash flows. If you want to make a profit through FX swap trading, then it would be the it would be based on the volatility of the swap points, not the changes in the exchange rate. So as I mentioned, swap points are vary based on the interest rate variations. So therefore swaps can be used to trade interest rate volatilities, relative change. So that's it about forward and FX swaps, but we have to discuss about short dated swaps, how to price short dated swaps. Before we move into that, please let me know whether you have any questions.
So page number 25.
25.
Yes. This is the sum of calculating the forward rate, but the same sum we subtract by -1, we can get the forward points. No?
No, that equation is slightly different. This is the forward points. Sorry, forward rate.
Right.
What is the equation for the points?
Page number 30.
Yes. What is the equation? It's not just -1 here. There's a difference. You have to put a bracket here.
Okay.
Is it clear now?
Yes, sir.
So basically it's derived like this. This is the forward rate to get the forward points, if I make it F points, forward trade minus spot, then you get forward points, correct? This is the forward trade, this is the spot trade, forward minus spot. Then there's a common factor, that's spot trade. Get spot trade out, these two brackets minus.
Yes, sir.
Anything else? If you don't have any questions, we'll stop here for a small break. Yes.
In that 47 slide, usually the market taker will profit from higher rate. No?
Market taker,
At higher note, he will get profit.
sorry, I didn't get that. Market taker,
Usually get profit from when he trade on the higher note. No?
no, market taker pays that. If the market taker trades at the high points, he pays it. So in this example,
Sorry, market maker.
market maker, yes. If he trades at high points, yes. So in this example,
So how can we
sorry, I cannot hear you.
In this example, so can we, based on the rates, can we decide whether he goes to earn a profit or not?
Yes. Basically, say go back to the previous, this one, it's very easy because the spot reference is remain same. Whenever this market maker does two transactions at the same spot at these two rates, definitely it will be a profit. He buys on the this side and sells on this side, so it's a profit. Profit of 1.1 pips. 1.1 pips into 10 million, 1100. Exact figure. But in the second example, there's a small doubt. Your profit is 1.1 points, but since the spot reference has changed, there's a small loss here. Then we have to think whether it is compensated, because it's not only 1.1 points, the dollar amount changes because of this spot rate changes. You can see instead of 1100 profit here, you can see now 2100 profit. That because of 1 point change in the spot price. That have an impact on the forward price, and it will have the impact on the final dollar cash flow. But the net profit remains same.
Okay, sir.
Forget about ignoring the funding cost of these dollars. in these two examples, remember, for the same bid and offer, the market taker has done two trades. If the market taker do two trades for the same bid and offer, definitely he is going to make a profit. That spread is his profit, market maker's profit. If the sub points moved away, then it will be a different story. You can do that as well. Assume, so say in this example, when he enters into the when the ABC Bank enters into the swap transaction with Big Bank, 3.2.5 are the applicable rate, but for this, assume it has moved to 3 to 2, something like this.
We can't see the screens.
Sorry. Now you can see.
Yes, yes.
Okay. Say, assume when the ABC Bank enters into the first transaction with Big Bank, these are the swap points. Spot remain unchanged, but when the ABC Bank enters into the sell by swap with the zero bank, these are the applicable swap points. Now what would happen? Now we are not sure whether it's a profit or loss, but yes, we can think about it. We can come to a conclusion, but due to this reason, you make, for the market maker may incur a loss. But if the market maker does two transactions on the same bid and spot, for one transaction on bid side and one transaction on the offer side, the profit is guaranteed. Whatever the spread is the profit for the market maker. Is it clear?
Okay, sir. Thank you.
Okay, try this. So in the first transaction, 3 months buy sell swap with the bank euro, what is the applicable rate? Minus 2.5. But in this, if these are the market codes, applicable rate is minus 3. Now this is minus 2.5, remains same. This will be minus 3. Then this will change. That will have an impact on this cash flow and on this figure as well. Anything else? So you can see profit goes down to 500. Instead of 1,100 rupees, sorry, $1,100, now the profit is only $500 because the sub points have changed. it can be, it can go negative if this goes below 3. Say it goes to, sorry, not below 3, below 2.5. Say it becomes 2.4 and 1.9, something like that. This first trade is done at these two rates. When the ABC Bank enters into the second transaction, the swap points are like this. Then it will be a loss for the ABC Bank. But for this to happen, there should be a changes in interest rate. Okay, anything else? Any other question?
Sir,
Yes.
Sri Lanka and China recently entered into an agreement for swap transfer. Can you explain briefly on that? About the nature and any impact on that agreement?
So that
If you can.
is what is the swap? What they have done?
Yeah.
That's agreement. What do you know about it? You have to tell me what you know about it. Then only I can explain.
Just only there is an agreement.
Yes.
Nothing more there.
What are the two currencies involved?
Dollars.
Dollars. The other currency?
No, rupees.
Rupees. So it's like this swap transaction. There are two legs. Central Sri Lanka receive 500 million USD. Say after 3 months, we have to pay $500. And meantime, we give the equivalent amount of rupees. Here we receive the equivalent amount of LKR. That's the basic. So this amount will be changed based on the rates agreed. The rates agreed depends on whatever the interest rates both parties agree. So we cannot work out anything without knowing what is the applicable interest rate on dollar, what is the applicable interest rate on LKR, and what is the 10. Basically, that this is what has happened.
Okay, thank you.
Anything else?
So this swap is only for 3 months, is it correct?
Which swap?
That recently established one? The period is 3 months? China one, yes?
I don't know. I don't have that information. Has it announced? What's the tenor?
China actually, they have not announced, no? There is another swap that is yuan to rupee, no?
Yes.
Previously, they announced that we can use.
Previous one is yuan. Yes.
Right. This one is in addition to yuan, no?
Yes, this is dollars.
And that yuan one is we can only use for the any imports from the China, no?
That's what it says in.
Yes.
Yes. For trade transactions, you can use.
Right.
Anything else?
So is it possible to have swap agreements more than 1 year?
Yes, possible.
Okay, thank you.
No. But generally, this FX swap is considered it's a short-term product, but still you can go for long period.
But so normally commercial banks do such longer period swaps with central bank, right? I have seen some swaps like that.
In Sri Lanka, yes. Okay, anything? So then shall we stop here? We'll take a break about 15 minutes and we'll start on the short dated swaps and we'll try to finish arbitrage.
Sure, sir.
How to explore arbitrage and what are the trades that we have to do. So we'll take about a 15-minute break here.
So that recently granted facility from the China is not a soft one, it's a term loan, I think.
500 million.
Yes, yes.
Maybe.
That is for, I think that is for 10 years with inclusive of 3 years grace period.
Okay. Interest rate?
It is not mentioned here. That I checked with the websites that they have not mentioned that interest rate. Anyway, when it is a term loan, that we have to face that exchange rate fluctuations, no? Which is beyond our control. If it is a sub facility that we have a control of exchange rate, but the only thing we have a period of 10 years to repay.
So what exchange rate that you refer to?
That means at the time of repaying the loan?
Yeah, but loan is in dollars.
Yes.
So what is the exchange rate that you are referring to? Dollar rupee?
Yes, dollar rupee.
Yes, yes. Because whatever the dollar amount that we receive, government has to convert it into rupees.
Yes.
To make its expenses. Then
Yes.
whenever government is going to pay it back, then the government has to buy from the market dollars at the prevailing rate.
Oh, otherwise, if we have dollar inflows to cover this loan, that's good, no?
Good, yes. But still the cost is the same because so whatever the inflow, the foreign currency inflow to the country, it won't directly come to the government. It will be through other sources in the market. Government has to pay rupees and buy to serve the loan. So the exchange rate impact will be there.
Yes. To my understanding, sir, that to repay that loan, is it a best thing at the 10 years time, get another loan in US dollars, in terms of US dollars, and repay it? Is it a good thing, or convert LKR into US dollars and repay it? What is the best way?
That depends. That depends. What would be the dollar interest rate at that time?
At that time, right.
And what applicable for Sri Lanka? So
Right.
whether we can borrow at a cheaper rate and whether we have enough inflows. We have to think all those things. Whether rolling over a loan, say forget about a foreign currency loan or things. If you take a loan as an individual, if you take a loan for a 10 years period, after 10 years, would you like to borrow again and pay the loan, or would you like to settle it and walk away?
It's depend of the time,
Depends
no?
on the conditions prevail at that time.
Conditions. That for that yuan rupee LKR swap, if there is any impact to the dollar exchange rate?
It should not be, yes, because there's no there's no inflows.
No inflows, yes.
Only thing is that there will be indirect impact. So if we settle anything with China trades in dollars, now if we can settle it in yuan using the available funds now in yuan, then there will be a less pressure on dollar. Nobody
But
wants to
pressure
buy
on
dollars.
yuan, no?
Pressure on
But
yuan. But the yuan will be supplied through this agreement.
And there might be that means increase in LKR yuan rate might be.
Might be, yes.
Yes.
Okay, shall we start the new topic? Oh, it's not rather new topic, it's the continuation of the same topic. But for the short dated FX outrights and FX swaps. What is short dated? I explained earlier. Overnight, Tom next, spot next, and spot week. However, in this presentation or this handout, we mostly focus on the overnight and Tom next. Even the spot next and spot week pricing would be same as the previous, because the second leg value date falls after spot. In the spot next and spot week, if you can remember what does it mean by spot next and spot week, you know that the second leg falls after spot date. So that would be a normal forward transaction, but in the market those are called short dated forward transaction. But our concern here is how do we price a overnight swap or a swap and a Tom next swap. You know what does it mean by overnight, or what is overnight means? What does it mean by overnight? The first leg is
today.
First leg falls on today, and the second leg
tomorrow.
Tomorrow. Tom next, first leg tomorrow, second leg on day after tomorrow. So now you can see pricing is happening before the spot date. All the rates applicable are not after spot rates, but before spot rates. So the price adjustment would be, or definitely should be, different from the way that we do for the other forward transactions. So that's the main concern here. Still, the forward points will be quoted in the normal manner. So this is an example for forward outrights or even the spot outrights. Spot rate is quoted in two ways, and the swap points or the forward points are quoted again two ways: overnight, Tom next, spot next. So it is same as what we learned so far, but only thing is how do we use these figures to derive different exchange rates or the applicable rate. Say we know what is a cash transaction. Cash transaction is a transaction where we settle the transaction on the trade date itself, value today. Cash transaction means in FX value today. So if we enter into the transaction today, we settle the transaction today itself. So then the question comes, what would be the applicable rate? In the market, generally the quotation is given for the spot rate. Then how do we derive the cash rate? So it is simply you change the sign. First thing, whatever the quotes given for the overnight, Tom next, spot next, you change the sign. So if the sign is negative, you make it positive, and you use ask figures to calculate the bid figures to calculate the offer side. So it's like cross division. Can you remember? Here also you change the sign as well as change the side. That's how we go back to calculate the short dated, basically overnight or the 1 day transaction, overnight Tom next sort of transaction. So to calculate the cash price, what we do, bid rate applicable for a cash transaction, how do we derive it? We start with the bid spot price, then do the adjustment for the overnight stop points and the Tom next stop points, but we use to calculate the bid side, we use points in the offer side with the negative sign or the opposite sign. So therefore, though these points are negative, we consider them as positive. So that's why we add here. We add these two overnight and Tom next points and multiplied by 0.001, that means divide by 10,000 to get the cash bid. To get the cash offer rate, we start with the spot offer and add the overnight stop points and the Tom next stop points, but again these are from the bid side and we have changed the so the reason for that, I'll explain why do we have to add two figures. Now you can see the board. Is it?
Yes, sir.
So this is today. This is P plus 1. That means this is the cash settlement date. This is P plus 1. This is P plus 2. Where this is the spot date. We want to find the value here. If you want to find the value here, what do? We add sub points. Generally what we do, we add sub points. We are moving forward. Now here we have to go back. So then what we have to do, we have to subtract points. Instead of adding, since we are going back in the time, we have to subtract. That's why we change the sign. Whenever we have negative points, we add them. Whenever we have positive points, we subtract them. And like in cross division, if you add the big figure, then it will become a big figure. But when you subtract it, it will become a lower figure. The result become a lower figure too. That's why we again proceed. Instead of taking bit to calculate the bit, we take the upper side of the points to calculate the bit. That's why we take the opposite side. But why do we have to add 2 points? So in the given course, you can see overnight sub points and from next points. There's no points for 2 days, 2-day period. The points are only for a 1-day period. And you see overnight means from today to tomorrow. What is the adjustment? Then the term next means from here to here, what would be the adjustment? So that means in addition it should be for a 2-day period. So therefore first we take the spot rate. We take the spot rate, use these sub points to calculate the term rate and use that term rate to calculate the cash rate. That's why we add or subtract term next point and overnight points together to derive the cash rate. Is it clear? Because we have to go back 2 days, but the points are given only for 1 day. What is the rate applicable here? What is the rate applicable here? That's why we add term next rate and the overnight rates. So this 3191 is the bid side of the spot rate. Then overnight term next sub points are 0.0160, 0.0260, but these are points. We have to make it decimal and change the sign. So 0.0160 plus 0.260. We add them together, divide by 10,000. This is the bid of the cash rate. To get the offer side, this is the spot offer rate, and these are the sub points, term next and overnight, but bid rates. Once you do this adjustment, you get the cash offer rate. We use the same principle to calculate the term, but now you need only 1 day adjustment from from spot to go back 1 day time. So therefore we use only term next sub points, but still we change the sign and proceed over bid and offer. So start with the bid of the spot, add the term next sub points on the offer side and divide by 10,000. To get the offer, start with the offer side of the spot and add Tom next stop points from the bid side. Why do we add here? Because the points are negative here. If the points are positive here, then we have to put minus sign all in these places. Can you see the mouse pointer?
Yes, sir.
Yes, sir.
Okay. So is it clear? When we go forward in the time, we add stop points. When we go back in the time, we subtract stop points. So therefore, when we subtract stop points, we have to change the sign and change the side as well. That means we have to consider offer rates to calculate bid, and to calculate offer, we have to consider bid stop points. So then we can derive outright exchange rates for cash transactions and Tom transactions. What does it mean? If you want to do a transaction, FX transaction value today, same date, then these would be the applicable exchange rates. If you want to sell whatever this currency pair, this is euro dollar, on the same date, this would be the rate that you will get. If you want to buy euro today on the trade date itself, this would be the applicable exchange rate. But in the Tom transaction, what does it mean? A Tom transaction, the trade date is today, the settlement date will be tomorrow. So then what would be the applicable rate? If you want to buy, this would be the one offer rate is the applicable rate. If you want to sell, this bid rate would be the applicable rate, assuming you are a market taker. So remember these things, decide on the spot rate which is required, whether you have to use the bid side or the offer side, then reverse both the side of the market stop points and change the sign, plus or minus sign, onto the other side. Remember that when you do that for a short date advance, that means cash transaction or a Tom transaction, you have to do this. So that's how we calculate the applicable exchange rates for the cash transaction and Tom transaction. And again, if it is for a swap transaction, only difference is, again, you may take the midpoint of the or the middle rate of the spot and do the same adjustment, and the points are given. Tom next and spot next, that means, sorry, spot next, it's something that we are going forward. You can use the normal practice that we had, but because it is beyond spot. But the cash transaction and the Tom transactions are before spot. Then we have to do the reverse. For the instead of adding stop points, we have to subtract stop points.
So these overnight and Tom next are quoted. I mean, they are quoted by the market maker directly for this purpose, right?
Yes.
So why can't they like quote it with the correct sign?
That's of course true, but I don't know what.
Is it the practice or maybe?
That's the practice. The practice, yes.
Oh, okay.
So can I see the board one?
Indeed, one thing, yes. The reason is 14 like this. This is go in line with what we have earlier. Because this is overnight. What is the sub point that you have to add to cash rate to get the TOM rate? Then in that sense, this is correct. Oh, the
Going
concept
forward
goes.
is correct. When you go back, you never.
But the thing is, yes, since the exchange rate is applicable for the spot, that we are going back. But since the sub points are quoted as overnight, that means from today to tomorrow, then it should be this way.
Okay.
That's why. That may be the reason.
Yeah, that makes sense. Yeah.
Yes, someone wanted to ask another question.
Can I see the board once? If you stand, I can see.
Yes.
Thank you, sir.
Okay. Anything else?
Okay.
Sir, any question?
Yes.
Sir,
Yes, go ahead.
in combat, why do we take that two different rates from overnight and from next?
I didn't get the first part of that question. In the
When we calculate in TOM rate.
TOM rate.
When
Yes.
we calculate the TOM rate.
That because the sub points are given.
Why do we take
the way the market quotes is what is the rate difference or the difference between two rates, cash rate and the TOM rate. That is the overnight sub points. Sub points are given only for one day. Then the TOM next, the sub points are given only for another day going forward, starting from here. If you know the cash rate, cash plus overnight, you will get TOM rate. Then TOM plus TOM next, you will get spot. That's how it's spotted. So now further, practically what would happen, we have the spot rate, we have to derive cash rate, then we have to do the reverse calculation. We know this sub points, then we take it to the other side, spot minus TOM next. That will give you the TOM rate. Then you can substitute it in this place as the TOM rate. Then take this overnight to the other side. Then you will get the cash rate. Did you get it?
So what I asked was that why do we take that?
Why do we take?
Not the TOM next, but the overnight.
Why do we take?
Not TOM next, but overnight. We take the note 260 and note 170.
When we calculate spot rate, no, sorry, cash rate or the TOM rate?
TOM rate.
TOM rate, then we have to use the TOM next points. Yes. 0.330 and 0.260.
TOM next and overnight.
No, we don't have to consider overnight when we calculate the TOM rate. Only the TOM next.
If you open the slide number 5,
yes.
Yeah, in that for bid you have.
Yes. That's my mistake. Sorry. No, it's okay. 260 is okay, but yes, this 17 instead of this 170, it should be in the offer side. It should be 330. Yes. That's the mistake.
If we can share the slide also, everyone can see.
Yeah. Then if the rate is correct.
330, no, it should be.
Okay, I think now you can see the slide. The change I made here is earlier this one was 0.0170, which is wrong. And if you use that, I don't think you get. Now I have to change the answer as well. 1930. Is it correct now? Can you? Sorry, it can't. Can you see the presentation?
Can't see.
Is it correct now? So this is the correction I made. Instead of 0.0330, I have used 0.0170, which is incorrect because this is the overnight rate. But as he mentioned, what we have to use here is the Tom next stop points. If you go back to the previous Tom next bid is 0.033. So then this should be the answer. Now it's correct. Anything else? Are you okay with that? Then shall I move into FX arbitrage? Okay. What is an arbitrage? First, we'll have to learn what is an arbitrage. So the arbitrage is not only in the foreign exchange market, even in other markets, we may see these arbitrage opportunities. So therefore, first we'll have to understand what is an arbitrage. It is that, so the same financial instrument may be priced at or priced in different ways. When you do that, if you don't get the same price, if you get two different prices and these two different prices are available in the market, maybe in two different places or maybe in two different ways that you derive that price, then there's an opportunity for you to make an profit without taking any risk. You buy from one market and you sell the same thing in another market, same time. So you don't have any exposure to the market, but you have make a profit. So that is basically an arbitrage. That is the that exists when there are price discrepancies in the on the same product or the same financial instrument. So therefore you can earn a risk-free return. You can earn a return without taking any risk, any market risk. So sorry, I'll qualify that, without taking any market risk. So in FX, there are three types of arbitrages: special arbitrage, triangular arbitrage, and covered interest arbitrage. So the first thing, all these three arbitrages are linked to three concepts that we learn. First thing, bid and offer. Special arbitrage is linked to the bid and offer. Triangular arbitrage applicable for the cross rates. Covered interest arbitrage is applicable or linked to the forward pricing. So you will realize now, to discuss this thing, you need to know what is bid and ask for the bid offer, what is cross rate, how to calculate cross rate, and what is a forward rate and how to calculate forward rates. And if you know those things, only you then it's easy for you to understand these arbitrage opportunities. The special arbitrage is very simple thing, very easy. Say for an example, you are quoted following two quotes by two different banks, Bank A and Bank B, say on euro dollar, okay, 1.15 2025 and 3035. When you see this, what you can recognize here, you see these two quotes, what you can recognize.
Base currencies at a premium.
How do you say? These are just spot quotes by two different banks. What does it mean, this 1.15, 20 and 25?
Positive way.
Huh?
These are positive.
No, what are these rates?
No, buy sales.
Buy sales on what?
Buy on base currency, euro.
Okay. What does it mean by 1.1520? How do you interpret it?
Market maker buy at 1.1520 and sell at 25.
Yes, market maker is willing to buy what?
Base currency.
In this example,
Euro.
At
the rate of 1.1520.
At the rate of 1.1520. So the market maker is willing to buy euro at the rate of 1.1520. At 25, that means in this case, market maker means Bank A. Bank A is willing to buy euro at 1.1520. Correct? Bank A is willing to sell euro at 1.1525. What does it mean? 1.1530. First, how do you interpret this?
Bank
1.1530.
Bank B willing to buy at euro at 1.1530.
Bank B is willing to buy euro at 1.1530 and Bank
Sell
C
at
is willing to sell at 1.1535. Okay. Now these rates are quoted by bank A and bank B to you. If you want to buy, at what rate you would buy? You,
2.5, sir.
you will buy at 25. If you want to sell,
30.
3,
15.
0. So now what is the market for you? It is 30, 25, isn't it? You are a market taker. You can sell at 30. You can buy at 25. So this is the market for you. Market offer, market bid is 30, market offer is 25. Is it clear? The market for you is 30, 25. Because these are the two banks quoted. The best bid is 30, best offer is 25. So this is the market. What do you do?
Buy low and sell at high.
Yes, that means you keep buying from bank A and keep selling to bank B. You don't take any risk. Instant profit. So this is the special arbitrage. Something wrong in this pricing or market force, because in the market offer is lower than the bid. That can't be. If it is the case, there is an arbitrage opportunity. You buy from the party who quotes lower rate and the party the party who quotes the higher rate. Generally, in the market, when you take market quotes from several parties, you should not be able to do this. Buy from one party and sell to another party at a profit. If it is there, then it's an arbitrage opportunity, which is called special arbitrage. You buy from one place and sell at the another place same time and make a profit without taking any risk. Is it clear? If you go back to our FX1 handout, and there was an electronic screenshot of electronic trading platform, go and see whether you can buy from one bank and sell to another bank at a profit same time, or based on the given codes. No, that there are about 6-7 banks and their codes. Even you get the best offer. If you buy at that offer, you cannot sell at the best bid same time and make a profit. Just check it in that slide whether you can do this. It should not be the case. Is it clear? Is it clear about this special arbitrage? Do you have any questions? If you don't have any questions, I'll move forward. The next arbitrage is triangular arbitrage. That happens when there are price discrepancies between three currencies. That means cross rates. When we have three currencies, we can calculate the cross rate. We'll start with an example. In the market, you can see these three codes. In the market, you can see these three codes. Euro dollar is quoted at 1.0753. Aussie dollar is quoted at 0.6535. And the Euro AUD cross is quoted at 1.6460. Euro AUD is quoted at 1.6460. Okay. Before we move forward, can you calculate based on the given exchange rates? Euro dollar exchange rate is given, Aussie dollar exchange rate is given. What would be the Euro AUD cross rate? Can you calculate it? Forget about this given rate. That's the market code. Forget about it. When you are given these two codes, what would be the Euro AUD rate if you calculate it? Can someone tell me the answer or how to get it?
So that is 0.6535 divided by 1.0753.
0.6535 divided by 1.0753. Any other answer?
So it's other way around. 1.0753 divided by 0.6535.
0.0753 divided by 0.6535. Yes, this is correct.
Yeah, other way, sir.
Then what's the answer?
$1.6454.
645. So based on the given exchange rates, this should be the cross rate, isn't it?
Yes,
1 euro equals $1.0753 and 1 Aussie dollar equals 0.6535 Aussie dollars. Then 1 euro should equal to 1.6454 Australian dollars. But the market is quoted something else. Which one is cheap? If you want to do a trade Euro AUD, if you want to buy Euro against AUD, which one is cheap? $1.6454. So we call this as the derived rate or the implied rate. So this implied rate is cheap, whereas the market is expensive. Then what do? So when you see this thing, you should immediately realize that there is an arbitrage opportunity. The market quote is different from the implied rate. Then there is an arbitrage opportunity, but only thing is you have to think about your transaction cost. So sometimes there may be small arbitrages, small amounts, but once you factor into your transaction cost, exploiting of that arbitrage would not give you profit. So you have to consider it. Now here assume no any other transaction cost, you can immediately recover or make this profit. So however, the basic is there is a difference. That's the first step that you have to do to discover whether there is any arbitrage. How to discover? First thing that you have to do, given the euro dollar and Aussie dollar spot rates, calculate the implied euro AUD cross rate. If that answer differs from the market quote, then there is an arbitrage opportunity. In this case, you can see there's a difference. So then how do you exploit it? If we go back, so this is expensive, this is cheap. What you can do? Sell euro in the market against Aussie. Once you sell euro, you will get some amount of Australian dollar. Then you go around to buy that euro amount again. You use this AUD to buy dollars, use that dollars to buy euro. Then what does it mean? You buy euro AUD at this rate, this implied rate. Then you can go through a complete cycle. Your position in euros would be 0. You will realize the profit in Australian dollars. We'll see how to do that later. However, at this point you can understand there's a difference, and if there's any difference, you sell whatever the market where it is expensive, you buy it in the place wherever it is cheap. So this slide explains how do you exploit or you do the trade to get that advantage and make the arbitrage profit. The simple concept is buy low, sell high. So in this cross rate example, if implied cross rate is greater than the market cross rate, that means implied cross rate is expensive, market cross rate is cheap. So then base currency is cheap in the market. On the other hand, if implied cross rate is less than the market cross rate, then the base currency is traded expensive in the market. So wherever it is expensive, you sell there and buy from the other market. But here the problem you have, what is the other market? Because market is quoted 6460 as we did earlier. This should be the implied rate. So implied rate is less than market rate. 1.6460 is the market rate. This is the implied rate. This is less than 1.6460. What do? Go to the market and sell euro AUD immediately. Say I sell euro against Australian dollar. That's the first trade that you have to do. Then try to buy back that sold euro amount in or through a different market. What is the other market that available? You can go to a bank and ask for a quote for AUD USD. So this should be the quote because that's the market. Then you can buy dollars paying AUD because when you sell a euro AUD, you get some Australian dollar amount. You can use that Australian dollar to buy USD. Once you complete the second transaction, you have dollars. You can use those dollars to buy euro at this rate. Then whatever the euro amount you sold, you have bought it here. You have gone a complete cycle. Your position is squared. Meantime, you have incurred or accumulate the profit or earn the profit. We'll put it or explain it here. So assume you begins with euro 1 million. Now you see the market is expensive. So therefore you sell euro against Australian dollar at the market. So sell euro buy Australian dollar at 1.6460. This is the market rate. You can get this quote from the market and you can trade at that rate. What is the AUD amount that you are going to receive? Can someone do the calculation? If you sell euro against Australian dollar, what is the amount of Australian dollar that you are going to get? You sell euro 1 million.
1,646,000 AUD.
Yes. So you will get Australian dollar 1,646,000. Now what do? You use this Australian dollar amount to buy dollars, US dollars. So sell Australian dollar 1,646,000 and buy USD at this rate. This is again market. This is the market code for AUD USD. What is the amount of dollars that you can earn? So you can buy. How do you calculate it? AUD USD rate is 0.6535. You have AUD 1,646,000. What is the amount of dollars you can buy?
$1,756,600.
Multiply 1.646.
Multiplied. What are you going to multiply?
So 1,646,000.
1,646 by 6535. Then what is the amount that you get? 1,075,660. So see, now I assume you can do these conversions. Okay, you sell euro 1 million at this rate. What is the amount of OC that you get? You sell this OC. You have this OC amount. This is the dollar rate. What is the amount of dollars that you can buy? That means you sell OC against dollar. Then what is the dollar amount that you get? Okay. If you use this exact dollar amount to buy euro, what is the amount that you can get? Assume you use exactly same amount of dollars to buy euro. What is the applicable exchange rate now? It is given there in the previous slide. Euro dollar exchange rate is 1.0753. The applicable rate is 1.0753. You have this much of dollars. How many euros can you buy at this rate? So you sell dollars and buy euro at 753. What is the amount of euros that you will receive? How do you calculate?
One million 75,661 divided by 1.0753.
Yes. Whatever this dollar amount divided by the rate, you get this much of euros. Correct? Is it clear? Or is this answer correct?
Yeah, I'm getting the same thing.
Yes. So then you start with, or you begins with euro 1 million. Now you are ends up with more than 1 million euros. This 335.72 is the arbitrage profit. But you should be able to do all these three transactions very quickly before market moves. And remember here, for simplicity, I didn't assume any bid ask. If the bid ask, or in the market, yes, you have to consider bid ask prices. At what rate you can sell euro, at what rate you can buy OC, sorry, at what rate you can sell euro to buy OC, then at what rate you can sell these OC to buy dollars, then at what rate you can sell these dollars to buy euros. You have to put all those things, then you get the correct figure. But however, to calculate the arbitrage here, again, there can in the market quotes there can be two-way quotes for euro dollar, OC dollar, and euro AUD. Then you have to calculate bid offer in the cross as well. You know how to calculate cross rates. Then see whether there's any discrepancy between the market quoted prices and the bid offer that you calculated. If there's any discrepancy, that means there is an arbitrage opportunity. First identify what is that, whether there's any arbitrage opportunity. Then identify what is that, which one is cheap, which one is expensive. Sell the expensive one and buy the cheap one. Here, in this example, you may remember what is expensive is euro, Australian dollar, cross rate is expensive. So you go to the market straight away and sold euro against OC in the market. Then you bought euro in the cheap market. What is that cheap market? Is in two markets with two different other currencies, OC dollar market and dollar euro market. You completed the circle in there. Is it clear, the mechanism, what you have to do? Once you complete this, you earn this profit. There's another way you could have realized the profit in dollars. Instead of converting all this dollar amount to euro, you can use only part of this dollar amount to buy exactly euro 1 million. To buy euro 1 million, what is the amount of dollars that you need to buy euro 1 million. At this rate, you need only 1 million and sorry, only this much of dollars, isn't it? Because 1.0753 is the rate. To buy euro 1 million, you need only this much of dollars, but you have $661. Then the difference is $361. If you divide this 361 by this, you will get 33572 euros. Same. So either way you can make it. In which currency you want to book the profit. So we'll move to the next one. Now in this example, market quote is euro dollar quote is remain same, Aussie dollar quote same, but euro is Aussie quote is 1.6450. Now since the spot rates remain same, implied cross rate should be the same, 6450. But now you can see market rate is cheaper than the implied rate. Then what do? You buy euro from the market. In the previous example, you sold euro at the market. Now, since the market rate is lower than the implied rate, you buy euro from the market. Then what other trades you do? You buy euro from the market, you buy euro and paid Australian dollar. Then what other two trades that you do in this market? Once you do this transaction, you have euro in your hand. Then what do? Sell euro against USD. Then you get some dollars. Then you sell these dollars to buy Australian dollar. Sorry. Yes, you have bought euro, then you sell those euro to buy US dollar, use those US dollar to buy Australian dollar, then Australian dollar, you need to sell euro. So again, you start with same like with euro, because okay, can someone explain why did we start with euro here, even in the previous example and in now this example? This is the base currency in the cross rate. That's why we start with euro. So we start with the base currency of the cross rate. So you have bought euro here, and that means you have sold Aussie. Now we have to cover that. So what we do, we sell these euro to buy dollars and use those dollars to buy AUD. Then you have gone through the whole cycle. You make the profit. The reason that we start with this is that is the base currency in the cross trade, but need not to be in that way. You can do it other way around. Start from any currency and go around and complete the transaction, but then you have to carefully select the transactions that you have to execute in the market. But when you select the base currency in the cross pair, it is very easy, but then the profit or loss would be realized in that currency.
So you don't have to wait until this first trade settle to do the second trade.
No. Yeah, then by that time the market might have.
Yeah, right.
You have to do it instantly. All three trades instantly before the market moves. You don't
So
wait
how do you like use that? I mean, you have to have all three currencies with you to do that trade. Is that
No, not necessary. Again, that depends on how your Nostro agents facilitate that. Because so if I go back here, you sell euro. Sorry. Yes, in this example, you sell euro. Then there will be a outflow from your Nostro account, and there will be an inflow to your Australian dollar Nostro account. And meantime, there will be Australian dollar outflow entry to the Nostro account. So the balance would be zero there. And in the dollar account, also same, there will be a credit and debit instruction from you. And in the euro account also, there will be a credit and debit. There's a positive balance. So to avoid the settlement risk, yes, counterpart the Nostro agents will ask you to keep the amount that you want to pay without waiting for the other party to settle your transaction. If everybody waits from other party to receive funds to settle your transaction, then there will be a deadlock. No settlement would take place. So there needs some injection of funds into the system. Then all pending transactions will be settled. So depending on that, if any of these Nostro agent is willing to give you or provide you a small credit line to settle this, you don't have to keep money in your Nostro account. But that depends on the agreements that you have with your settlement agents. Otherwise, you have to fund these accounts. Yes. Is it clear?
Yes, sir. Thanks.
So we'll go back to our second example. In this case, implied rate is higher than the market rate. So therefore, what do? You buy from the market. Buy euro from the market. Then you use those euro to buy back Australian dollar. So begins with euro 1 million. Then whether this is 1 million or 10 million or 100 million or 1 euro, it's up to you. Whatever the amount, it doesn't matter to realize the profit. Based on the amount, the profit that you realized will be changed. So in the previous example, we realized 335 euros for a 1 million euro trade. Remember that. For a 1 million euro trade, you realize only 335 euros as a profit. But this is a risk-free. Without taking any risk, you earn a profit of 335 euros. So you might see for a 1 million trade, this is a very small, but it's not. That's how you accumulate profits. So even here, we'll see what is the profit that we are going to realize. So we start with euro 1 million. We sell that euro 1 million against dollars to buy dollars. We sell this euro 1 million to buy dollars. Then you will get this amount of dollars because this is the exchange rate. Then you can use this same dollar amount to buy Australian dollars. What is the exchange rate? 0.6535 or something like that. Yes, 6535. Then what's the amount of Australian dollar that you can buy? What's the amount of Australian dollar that you can buy? You divide this dollar amount by this 6535, then you get 1.645447 Australian dollar. So then we can use this Australian dollar amount to buy euros. If you do that at this rate 1.6450, you will be able to buy euro 1,272,000. So then you will realize the profit in euros. You have to do all these three transactions quickly, but this is only one way of doing that. You go this way, but if you need, you could have gone this way as well. First do this buy euro, sorry, but the direction would be the same, but start from a different place. Instead of begins with euro, you could have begins with Aussie. That's what I explained earlier. Then buy euro, use this euro to get dollars, use those dollars to get Australian dollar. So then you will realize the profit in Australian dollars. Or you can start with fixed amount of dollars, then go around the same cycle in the same direction. Then you will realize the profit in dollars. Either way, that can be done, but it's easy to start with the base currency. Any question? Only thing is you should be familiar with how to calculate cross rate and how to calculate the equivalent amount given one currency amount. Equivalent amount of other currency. It could be base currency or the counter currency. You should be able to calculate the equivalent amount of in other currency when the exchange rate is given. Any question? If you don't have any questions, we'll move into the, so this is triangular arbitrage. These are the two scenarios that can happen. What if currency pairs may be different, but these are the two scenarios. First one is this one. Implied cross rate is greater than the market cross rate. Then the base currency is trade cheap in the market. This is the second example that we discuss. The other scenario is cross rate is implied cross rate is less than the market cross rate. Then the base currency is traded expensive in the market. This is the first scenario we discuss. Follow this strategy, buy low and sell high to earn the arbitrage profit.
So if this happen practically?
Yes, sometimes. For some currency pairs, you can do this.
So can I see page number 6 and page number 10 again?
Page number 6. Sorry, this is page number 10.
6 and 10.
Yes, this
6
is 10.
and 10. Okay, sir. 6.
Page 6.
Thank you, sir.
Okay. Okay. Anything else? So the third arbitrage opportunity in FX market arises due to discrepancies between implied forward rate and the market forward rate. So that's why it says covered interest arbitrage, because that happens due to differences in interest rates used in the market to price the forward and your borrowing and lending ability in different currencies. So depending on that, this opportunity will be available in the market. The previous one, triangular arbitrage, is very rare, but still that can happen. But in the covered interest rate arbitrage, this is nowadays a bit common thing, because some of the regulatory requirement, some currencies are at a high demanding position, so the interest rates are very low in that currency, and other currencies the interest rate is high. Because of high demand, those currencies interest rate is high compared to the other currencies, and when you do a sort of a swap transaction, you get better interest rate. So therefore, with the combination of a swap and a deposit, something like that, you can earn this arbitrage profit. So this is exist in the market. So as I mentioned, so this happens when there is a misalignment between spot rate and forward rates and the interest rates used in the market and what is available for you. So for example, we'll take this again, euro dollar spot rate and the interest rates, market interest rates. So you can borrow or lend euro at 2% for 90 days, and you can borrow or lend dollar at 3%. Again, remember, in practice, you may see bid of a year, bid of a year, bid of a year, and bid of a year. So you have to apply the correct bid offer rates and derive the correct forward rates. So these information are given. How do you know whether there is an arbitrage opportunity? What should be the first step? spot rate is given, two applicable interest rates are given, market forward rate is. What do? The first thing, like in the previous exam, previous case, we have to calculate the implied forward rate. If the spot rate is this and the exchange interest rates are these, what would be the 90-day forward rate? So first thing, calculate the implied forward rate. So if you use these figures, say 3% $4, euro 2%, you can see, and 90 days, 360 day count convention, 3% on dollars, 2% on euro. Remember, in this euro dollar pair, dollar is counter currency, so that's why dollar interest rate at the top, and euro interest rate at the bottom for the denominator. So this is the implied forward rate. What is the market forward rate? 1.0775. So the implied rate is higher than the market rate. So there is an arbitrage opportunity. Which market is cheap? Forward market or the implied forward? Forward market is cheap because the rate is low. So market forward is cheap. What do? Buy a forward at the market price. You buy euro at this rate for a 90-day period. Buy a 90-day forward at 1.0775. That's the first thing that you do. So these are the trades that you have to carry out at time 0. You buy euro against dollar in 90-day forward at the market price. So your applicable rate is 1.0775. So what would happen once you enter into this transaction? This is t equals 0. This is t equals 90. You have a euro plus position here. What do you want to do? You want to create a euro negative position. How do you do that? You create a liability in 90 days. The simple way, you borrow euro for 90-day period. So then on this date, you have to pay that amount. You borrow euro for a 90-day period at the interest rate that given 2%. So then you borrow euro means you have a plus euro position here, because indeed not it's here, it's in T plus 2 spot market. You have a plus euro position here. Now what do? You want to create a negative position. Whatever the borrowed amount, you sell against dollar at the spot rate. So you borrow and sell that amount. Then that will create a plus dollar position. What do? You lend that dollars for a 90-day period. Then you will get a plus USD here, minus USD here. This plus USD you can use to buy this euro. That's what you do. You cover everywhere all your positions, make it 0 net balance. But in one currency you will realize a profit. So these are the transactions that you do at time 0. You enter into a forward buy. If you buy forward the base currency, you borrow the same currency today and sell it at the spot market and get the counter currency and lend the counter currency for the same period. That's the basic. If the market forward rate is cheap, buy from the market forward, borrow the base currency on spot basis, sell that borrowed amount to buy the counter currency on spot basis, lend that counter currency for the same period. In this example, 90 days. Then what would happen on the maturity date? You have a loan, an investment in dollars at 3%. So you will receive dollar with interest. Meantime, you have a forward contract to buy euro. So to buy that euro you need dollars. How do you find that? There's a dollar inflow here. You use that dollars to honor your forward contract. You buy euro. Then you will get a euro amount. Meantime, you have a euro liability because you borrowed euro for 90 days. So you pay that liability with the interest. Then there will be excess dollar amount in your pocket. That is the profit. So these are just the steps that you have to follow, and on the trade date and on the maturity date. Then we can calculate the figures. So at time T0, you buy forward euro 1 million at the market price. Then what do you do? Sell euro and buy dollar. But remember, since you are buying euro 1 million on the forward date, you get euro 1 million on this date. So therefore, you cannot sell euro 1 million here. But what you do is calculate the present value of that euro amount and sell only that euro amount to get the dollar amount. Then you lend this dollar. So you borrow only that amount of euros. So then you sell it and get these dollars. You will lend that same amount of dollars. You can see same amount of dollars at 3% for a 90-day period. So in 90 days, what would happen? You get principal and interest on these dollar. You know how to calculate that. This is the principal amount. This is the interest rate. It's only for 90 days. You receive this much of dollars. Then what you can use, what you can do, you have a liability in this transaction to pay $1,077,500 to buy euro 1 million. So you do complete that transaction, or you honor your obligation. Pay this amount of dollars to buy euro 1 million. Then there's a borrowing of euro. You bought this at 2%, then this will become 1 million. So the borrowed amount would grow into 1 million. So you bought 1 million here. You can use that 1 million to pay your euro liability. Nothing is there. Then the difference in dollar amounts is the profit. So this is when the market rate is cheap than the implied rate, or on the other hand, implied rate is higher than the market forward rate. Then you buy the base currency forward from the market, borrow base currency on the spot basis, sell that base currency amount to generate counter currency, invest that counter currency for the same period as the forward rate. Then the other way, or the other opportunity comes when the market price is higher than the implied rate. So this is the market rate, market forward rate for 90-day euro dollar exchange rate. Spot is given, interest rates are given, so you can calculate the implied rate. The implied rate would be the same as what we had earlier. What was the implied rate? 779. So 779 is higher than the 7785. So this is the implied rate. 779. Sorry, it's 779, 1.779. So implied rate is less than the market rate. Market rate is greater than implied rate. So therefore, market is expensive. What do you do? Sell euro forward, 90-day forward, because you sell the expensive one. Since you have sold euro and bought dollars on a forward basis, what you have to do? Borrow counter currency. In the previous example, can you remember? We borrowed base currency. In this example, in this scenario, we borrow counter currency for the same period, and we use this borrowed counter currency to buy the base currency in the spot market, and we lend that base currency amount that we generated or bought through the FX market for the same period. So after 90 days, we will receive base currency amount. In this example, euro with interest. We have to use that euro to buy dollar as per the forward contract. Sell euro and buy dollar. So we use that euro inflow to buy dollars. Then there is an obligation for us to pay the loan that we borrowed dollars. Pay that dollar with the interest to the lender. Any excess is the profit. Again, I'll put it into the numbers. Sell forward euro 1 million at 0.0785. This is the market rate. So then buy euro, again only the present value, not the amount that you sold or bought here in the forward market. Only the present value of that. So buy euro, present value of the forward contract, and sell dollar. So to sell dollars, we need dollars. How do we fund that position? We borrow dollars. We borrow dollars to meet this requirement. And when you sell dollars and buy euro, there's a euro position in your hand. What do? You lend that euro. So after 90 days, first thing what would happen? You will get interest and principal on this lent amount. You receive exactly euro 1 million. So there's a contract, an obligation to sell euro 1 million at this rate. So you honor that, use this euro 1 million to honor this transaction. You get this much, about this much of dollars. So you have borrowed dollars here. Use this dollar to pay your loan. You need only this amount of dollars where you have more than that. The difference is $625.37. That is the profit. So that's how we explore, or we identify whether there's any covered interest rate arbitrage, and that's how we do set of transactions to exploit that arbitrage opportunity and make the arbitrage profit. Any question?
Can I see the page number 12? Okay. Thank you, sir.
Anything else? So this completes our foreign exchange module. But how to manage foreign exchange risk, we'll discuss in risk management once we discuss about derivative products as well. So then remember, by that time again you should be able to or you should remember these things: what is a forward transaction, what is a, how to calculate the forward rate, and how to calculate cross rates and things like that. So from next week and onwards, most probably, because that was the plan, Perry will take over class and take you through the treasury management side. That means basic of treasury management, fundamentals of treasury management. What is treasury role? What are the functions? What is the organization of the treasury, and things like that. Once you complete that, then we'll start with fixed income securities. So I'm not going to discuss foreign exchange again until we get into the risk management side. We may use some foreign exchange in when we explain derivative products, but mostly on this about spot transactions. So that's the plan. Any question?
So next lesson will be on treasury management
Yes,
function, right?
that will be the module 2, I think.
And you will be coming on, sir, for fixed income securities.
Yes,
that
yes.
one.
I'll be here again for fixed income securities, maybe after 3-4 weeks.
Thank you, sir.
Anything else?
Sir, there will be questions from this arbitrage.
Yes. Whatever we discuss, there will be questions.
Arbitrage question
Yes,
should
yes.
be there in the
Yes,
question.
yes. Whatever we discuss, there will be questions. Maybe in some instances, I will tell you, I'll explain. Though we discuss here, it won't come in the exam, but it is in a very extreme case. Yes, next week onwards, the module 2, Treasury Management Function. That module will start. In general, our allocation for that is about $12. So probably within 3 weeks, that module will be covered. But yes, there's no hard and fast rule for us to complete that, depending on your level of understanding. So we'll try to change this schedule. So far, I think we are on track. That's one good sign. So 24 hours allocated for financial markets, but I think we took more than that, and we didn't discuss fixed income securities market yet. So from next week onward, for 3 to 4 weeks, there will be sessions on treasury management functions by Perry. So after that, we'll discuss about fixed income securities market, for which you need knowledge on calculation of again present value and discounting and things like that. Present value, future value calculation, discounting. That knowledge you need again. So don't during that next 2-3 weeks in the treasury management functions, you don't, most probably you won't do any calculation things like this, what we discussed so far. But after that, again, you need it. So don't forget about those. Do some questions and revise it regularly. If you don't use it in your day-to-day office work, if you do that, yes, then you will have some understanding, or you won't lose that. If you don't do that, yes, definitely you will forget about those things. But don't let it to be happen.
So to complete the first module, we have to
Finish
another
capital fixed income, yes,
and capital market.
That we have completed. What is capital market, money market, all those things we discussed at the very beginning. Anything else?
Derivative markets will be discussing
After fixed income, it's a separate module. To discuss derivative markets, you need knowledge on fixed income, interest rates, and foreign exchange as well.
In capital markets, we don't go into details, right? Only
Because it's capital market comprise of different products. We are going to, so fixed income security is one of those. As I mentioned very beginning, we are not going to discuss about equity market here, because it's almost not relevant for a treasury. It would be another vast area, how to price equity. Then we have to discuss about a lot of models. It is not necessary here. Therefore, we are not going to discuss about stock market. But other capital market products, some of these we are discussing. Most of the other major one is the fixed income security market. We are going to discuss it here.
Now, as a treasury operation, investing in equity units and shares, there's some amount of knowledge needed for the for that part also, no?
Yes. It's in some treasuries only you do investments in shares, but in a bank, I think mostly focus is on fixed income and foreign exchange and related derivatives products. So that's why we are not going to discuss shares. If you think that is important, you can suggest. Then I don't know whether this time we can introduce. If the demand is there or the requirement is there, we can introduce that part also.
Yeah, even it'll be
then we may have to extend the period as well.
Yeah, even at a high level, even without going into detail and pricing and things, just at a high level on how does investments work, and
so that is basically we covered
in capital markets.
In capital markets, yes.